So for you, my friends out there whose interest rates has become the boogeyman to you, I've got someone that is really vast, knowledgeable in the industry to speak with you today by the name Heinz. Welcome to the show, Heinz.
Thank you, Sean.
Can you let us know a little bit about you?
Yeah, so my name is Heinz Sean. I've been with Vancity since 2009. I have been doing mortgages since 2012 and as a mortgage specialist since 2014. I actually left Vancity and became a mortgage broker for 3 years.
Oh, okay.
Then I went back to Vancity. So I'm kind of understanding the world between the mortgage specialist in the bank and also the broker side as well.
Outside the bank.
Yeah, so I have quite some knowledge about the industry.
Oh, good to know. Good to know. So definitely we have someone of an authority here, right?
Yeah.
Let's get into it. You know, even now, some people don't really know what a mortgage is. They don't know what a mortgage is. They don't know how it works. Can you break it down, please?
Yeah, in the simple terms is if you want to own a piece of property or piece of land, you would take that as a collateral to the bank or a credit union, and then ask them to use that as a collateral to lend you money to purchase this property. So the lending that the bank provided to you, we call it mortgage. We put a mortgage, put it on the property. The bank has the name and title on the mortgage, so that they on the property, so that they can offer you this lending.
Awesome.
So it's secure lending. Yeah.
That's good. So, mortgage, right? I know it has a relationship with bond.
Yes.
So, what is the relationship between mortgage and bond?
Yeah. So when the bank determine the interest rate, they look at the bond yield, and this is talking about a fixed interest rate. So we're talking about fixed rate. So there's two types of mortgage: fixed rate mortgage and variable rate mortgage.
Okay.
With the fixed rate mortgage, the bank will look at the bond yield, and in Canada we usually look at the 5-year Canada bond yield, because the 5-year mortgage is the most common mortgage people take. So what they do is they will look at the bond yield movement, and that would determine how much or how they determine the mortgage interest rate. Mortgage rate usually is higher than the bond rate or bond yield. It's because mortgages require more maintenance every year or every now and then for the bank to maintain this lending. So they will charge higher interest rate, or that investment has high return to the bank, so that they will put money into the mortgage rather than putting money into the bond market.
Oh, okay.
Yeah. So when the bond market or bond yield goes up, the mortgage rate will go up as well. Yeah.
Oh, okay.
The other type of mortgage is the variable rate mortgage. That is determined by the prime lending rate determined by the bank, and that prime lending rate is affected by the Bank of Canada overnight lending rate. So the one that you hear on the news, that they meet and then they say they will remain the same, they will increase or they will decrease, that is the Bank of Canada overnight lending rate, and that is the rate that affecting the variable rate. Yeah, so the bank's lending rate is based on that Bank of Canada rate, and then they will adjust it accordingly. When it's in a increasing environment, the bank usually reacts really fast. But when it's in a decreasing environment, when Bank of Canada stops dropping rate, the bank might react a little bit slower. It might not drop right away. So, but those have some correlation to it. Yeah.
Oh, sounds good. Sounds good. So as of today, what is the median mortgage interest rate?
Most of the interest rate these days is regardless 1 year to 5 year terms, they are sitting around 5 to 6% range. So the best rate you can get is those high ratio CMHC mortgage around 4.99, 4.89, around there. That would be the best rate you can get today. But most of the people will be looking at rates between 5 to 6%.
Okay, with good credit and income as well, right?
Yeah. So when it comes to a mortgage, we need to assess the risk. So basically, the interest rate is based on the risk of the file. The higher the risk, the higher the rates. So the risk, what risk we refer to is the person's ability to repay this mortgage.
Oh, okay.
So the better income they have, better credit they have, then that means they have a better chance of repaying this mortgage on time. So the risk will be lower. So the interest rate technically a little bit lower.
Okay, sounds good. All right. So in your experience, what is the best mortgage to get today? Because, people before, right, when we used to have the variable at like 1.5, 1.2, at some point 0.99, people were rushing into variable. But as of today, the variable is even higher than fixed, right? So in your experience, what do you think people should get as a mortgage type moving forward?
Well, none of us have the crystal ball, right? The old saying.
Absolutely,
so we don't know where the mortgage rate is moving to. But most of the general opinion from all the economists is saying that the interest rate is going to drop in the next 1, 2, 3 years. We will see a slow, like some decline this year, and then we might see another decrease next year or more decrease in the coming years. So the general consent is saying that the interest rate will be lower in the next 1 or 2 years.
Okay.
So most of my clients these days, they're picking either the 2-year term or 3-year terms so that they can time kind of when they at the renewal, they can renew at the lower points. But if for clients that they think the interest rate is going to drop really, really fast, then taking the variable rate might be a better option.
Okay.
So it depends on what the personal preference is. If people want to anticipate the interest rate will drop really fast, variable rate might be a better option. But if they anticipate the interest rate will drop, but drop pretty slow and steady for the next 2-3 years, then maybe the 2-year fix or 3-year fix is better option.
Actually, like what the banks came up with, right? With instead of going 5 years, you could go 2 or 3 years fixed, right? So in case it drops,
then you can renew at the right time.
Right?
Yeah,
that's really great. And then looking at the whole thing, right? Like, what do you think people need for down payment? Like, how does down payment work?
Yeah, so there's 2 types of mortgage in Canada. One is called a high ratio mortgage. The other one is called a conventional mortgage. For the high ratio mortgage, you need as low as 5% down payment, and you will be able to get into the housing market. With high ratio mortgage, the mortgage is required to insure by the insurance company. So there's a few insurance company in Canada. The biggest one that most people heard of, the name is CMHC. So they the one who come up with all the reports, all the news that you will see on the TV. So with 5% down payment, you can get into housing through the high ratio mortgage. And this CMHC is required, like their insurance company. So what they do is they actually insure the bank in case in the event of a default, like the client doesn't pay back the loan, this insurance company will pay back the bank. So to the banks, they have no risk on this file, on this application, basically. So the bank can offer you the best interest rate. But because it's the insurance, so this client will have to pay insurance costs to CMHC for the insurance to insure the bank. The other type of the mortgage is called the conventional mortgage. Typically, we need minimum 20% down payment. Depends on the purchase price. If your client's buying some luxury home like in the $4 or $5 million range, then they might require more than 20% down payment. But in general speaking, 20% down payment is the standard for conventional mortgage.
Okay. So coming to that, right, I was going to ask you when you mentioned the 20%. So typically, as a real estate agent, right, when I bring my clients to write an offer on a home and all that, offer gets accepted, we put down 5% after inspection and all the due diligence, right?
Yes.
So let's say I'm purchasing in a range of something over 1 million, which is going to require 20% minimum, right?
Yes.
I put down 5%. When do I have to bring in the next 15%?
Yeah, you don't need to bring in the rest of the down payment to the bank, but you need to bring it to the notary or lawyer when it's at closing. So usually it's the day or two before your completion day that you set on your purchase contract.
Right.
However, when we're doing a mortgage application, we need to confirm that you have this money, you have the ability to come up with the money to complete on the purchase. Otherwise, we will not extend the financing to you. So. A lot of people, they don't know is the down payment. We actually have a requirement on how long we need to see history of the down payment, basically.
Oh, okay.
So typically, most of the banks and credit union, they want to see 90 days of the history of the source of the funds. So basically, you want to see where this money were in the past 90 days,
right?
In order for us to accept it, because we cannot accept. Like, we need to know where the money is coming from. It cannot coming from an unknown source. But the down payment, typically people's down payment is coming from the savings, the RSP, the term deposit, the investments, or gifting from the family
members.
Yeah. So these are all accepted source of down payment. But we actually cannot accept any third party money or a borrow funds as a down payment, because then then your total risk will look different because you borrow money from elsewhere.
Okay, that sounds good. Yeah, so outside of my 20% down payment, I heard you mention the cost of if I'm doing 5%, right? So there's going to be insurance cost. Yeah. Are there any other costs? Say I'm a first-time home buyer, I don't know nothing about.
Yeah. If you're doing 5% down is CMHC mortgage, the insurance cost actually can be part of the financing. So you need to come up with it on the side. But other than that, there will be some closing costs you need to keep in mind. Depends on the property you're buying. You might be subject to property transfer tax. There will be closing costs, the lawyer fee, the property tax adjustment for the year. If you're buying a strata property, then the strata company might want to collect 2 or 3 months ahead of time, so that you have time to set up the auto payment. You have home insurance, so you have to pay usually upfront 1 year home insurance cost. So on the side, you should set aside some money. Depends on the purchase price size, but you might want to set aside $5,000 to $25,000. Depends on the situation, if you need to pay the property transfer tax or not.
Okay, sounds good. So what about if I'm purchasing a pre-sale, right? It all comes with GST. Can those GST be worked into the mortgage as well?
Yeah, GST is part of the purchase price, so it can be part of the total purchase price of the property.
Okay.
So there's a couple institutions like Van City. We can actually finance your property based on the market value as well. So so if you purchase a home like 4 years, 5 years, 6 years ago, let's say 500,000, and today the property worth 600,000, we can actually finance it based on the 600,000 rather than the 500,000. So you can actually get more financing and to cover the full GST. And some extra money for you to pay for the property transfer tax and closing costs. Yeah,
that's great. So, let's say I purchase a home today, right? Over $1 million, and my down payment should be 20% minimum, right? And I did 5% to get everything going. And what are the things I should avoid before the closing day? Because I know, I could have some bills or some other, expenses, right? What are the expenses I should avoid before the closing?
Before closing, I would say, you don't want to take on any new liability, new debts. You don't want to take on a car loan. You don't want to take on any personal loan, because you're getting into for most people, the biggest purchase in their life. So they want to make sure that payment's comfortable. They should move in, settle in first before they taking on additional liabilities. Because when you first move into a home, there might be cost of furnitures, and a lot of unexpected costs might come up. So you might want to control yourself not to get into any more liability before the closing of the home. But and other thing is, if you actually take out more loans before closing, if the banks might notice that, and then they may tell you that, now we need to rewrite your mortgage. We might not be able to qualify for this much. So it's something good to keep in mind. Just settle in first before you take the next step in your life.
So pretty much whatever state I was while putting in the application for mortgage, just be in that state till closing.
That's right, yeah.
Okay. That's great. And what do I have here again? So pay mortgage, right? In most cases, people do once a month. Do you know a better way to, depending on, let's say I want to get maybe pay off my mortgage really quick, as early as possible, right?
Yeah.
How can I go about that?
Yeah, so there's a few things you can do to pay off your mortgage early. So most of the people, they will do monthly payment because that's traditionally people get paid once a month.
Right.
But these days, I see a lot more people, they're doing bi-weekly mortgage payment. So ideally, the idea is to have the mortgage payment frequency match your payroll frequency so that your cash flow is more comfortable.
Right.
Because sometimes if you only get paid once a month, but then you're paying your mortgage in a weekly or bi-weekly basis, sometimes you might be short on.
Kind of hot the pocket.
Yeah,
right?
yeah, exactly. So you want to make sure the cash flow is doable. So most of the people, I would suggest them to match their payroll frequency. But in terms of the math, the weekly payment will get you more, like overall you pay less interest when you do weekly and then bi-weekly and then monthly. So a lot of people, they also do accelerated weekly or accelerated bi-weekly. So what that means is instead of 12 payments a year, you're actually making 13 payments a year. So then you're paying a little bit extra into the principal.
Right.
But like I go back to what I was saying, that I usually suggest people to do the payment but match their payroll frequency. And then I suggest them what they will use this lump sum payment allowance to pay extra into a mortgage, so that's another option to pay off your mortgage faster rather than change your payment frequency to weekly or accelerated weekly to affect your cash flow.
Yeah.
So for example, like we all have we all do our tax return in April, May, June, right? So most of people, if they don't have a lot of outside income, they might get a refund after the tax return.
Oh, okay.
So what a lot of people do is they would do the bi-weekly payment, and in April when they get the tax refund, they would just put that in as a lump sum payment. So that is an option to pay off your mortgage faster. Mortgage. Yeah.
So talking about lump sum payment, right? How much? What was like the highest I could pay without getting, fine? Getting the penalty.
Every bank is different. So, but the industry range is between 10 to 20%. So
of your face value, right?
Yeah. So some is based on your outstanding balance.
Okay.
But for Van City, we're based on the original mortgage balance.
Oh, okay.
So in other words, you can pay more at Van City compared to other banks. And at Van City, we allow 20% extra every year. Some other places may be doing 20% based on the outstanding balance, or 15%, 10%. So when it comes to mortgage, this is a very important detail to look at rather than rates, because if you have a low rate but it's restricted on how much you can pay extra, so if you won a lottery, you want to save interest, you want to pay off early, or even some people, more realistically, they have inheritance coming from the grandparents or whoever, and then they want to pay off early. With the restriction, they cannot. So, which means that they have to stuck to pay the interest that they don't have to. So even though they have a lower interest rate, end up they still paying more money. In other words, so this restriction or terms and conditions is very important when it comes to a mortgage.
Okay, sounds good. So we've talked about mortgage. That's like on the whole table, right?
Yeah.
Let's talk about Van City. What does Van City have for people like in this market of today?
So Van City is a credit union. So it's a local credit union, and we only service people who live in BC.
Okay.
So the main difference is let's say the general difference between us and the bank is when you bank with us, we call you a member. We don't call you a client. Okay. So you're actually the owner of the organizations. So compared to the big banks, you're just a customer.
Right.
Whoever buys the stocks is their shareholder, is the owner of the company. So then you can see kind of like the idea of how we work towards our customer or members a little different. So for the banks, they want to make money from the customer and then share the profit with the shareholder. Okay. But with us, you are actually the owner, the member. So the money that we made from you, we still need to share it back with you at the end of the year.
Oh, I never knew that.
Yeah, so then the attitude, right? It's not talking about like we're talking about the way that interacting with the banking staff is totally different because we are owner to owner on this during this transaction rather than I'm a banker and a customer doing the transaction. So the whole experience is a different. You would like we always get recognized with our service rather than like other things, right? So because just the way how fancy it is. But in terms of the mortgage qualifying, being a local credit union, we understand the BC market more. We understand the local people more. So our policy is more tailored towards the local crowd, local people. We have a lot of unique or niche product that will fit people in this community rather than the banks. So because the banks are nationwide, some of them are global, right? So the policy might design for the whole nation. And you will know that the housing market in Vancouver compared to Saskatchewan is completely different compared to New Brunswick is totally different, right? So you cannot use the same policy to apply for all the areas. So we actually know that, and then we only service BC, so we have more tailored policy,
community based, right?
Yeah, like something for an example is. Vancouver housing price is so high, people like getting into a single family home is easily $1.5 million purchase price in today's market. We understand that to make that payment to support that $1 million mortgage is very hard, very tough. So we have programs like something called a purchase plus improvement will help you finance the renovation cost of to create a suite in the home so that you can have some rental income to help you with the qualification. And then we will recognize that rental income when it comes to mortgage qualification so that you can get a larger mortgage amount to achieve the dream that owning the single family home.
Wow, that's a great one because some people wouldn't even lend you the money to do the extra suite, right?
Exactly.
And then use it as an income for you.
Yeah, we will use that as an income to qualify. So we are very strong in using the rental income because we understand Vancouver has very low vacancy rate. So the risk of the people losing that rental income is not that high.
It's really low.
Yeah, it's very easy to find a replacement. So we take in a lot more rental income compared to other institutions. We understand a lot of people in BC, the investment portfolio is in the housing. Compared a little bit different than other area. A lot of other people might be investing in stocks and other things more, but in BC, a lot of people, the investment majority is in the housing market.
In housing.
So we recognize this rental income, and then we actually allow people have more than like 5, 10, 20. We have no limit on how many property they can have. But for other banks, they only they restrict it at 5 units only. And if the person has like 6 or 7 property, they cannot give them a mortgage anymore. Right, things like that. We know that there's a lot of construction, new housing going on, so we have really good construction policy. And then even for the first-time home buyer or for a lot of young buyers, they saving up that down payment is hard. So we actually allow the 100% of the down payment as a gifted down payment. So most of the banks, they want that borrower to come up with some of their own money as a down payment. Right. But for us, we understand because that's just how the housing market is, how the culture is. They're getting the 100% down payment from their parents, and then we will accept that as a down payment for the purchase. And even people buying a rental property, we will allow that because a lot of people, they want to help their kids. I don't know about for my own culture, right? For the Asian culture, right? And my parents would want to help me, set me up for success. So, definitely. So a lot of time when I first working for a year or two, they want to help me get into the housing market. But doesn't mean that I'm going to live there, right? They might just help me buy a rental property, and I will still live with my parents. But it just helped me build up, in terms of financial status, right?
Yeah.
So we will actually help these individuals, right? We understand the cultures. We will accept the gifted down. We will do that as a rental property, and then that is a big difference compared to other banks.
Well, that's great. So, being a real estate agent, I've seen quite a few things in the market. People purchasing grow-ups without knowing, right?
Yeah.
So if they're going to sell it, it becomes a problem.
That's right.
For them, for the buyer as well.
That's right.
Does Vancity have anything to like mitigate in this situation?
Yeah, so we, of course, that is the due diligence the buyer has to do. Right? When they buy it, they need to look at all the documents, make sure it's a property that they want to purchase. And for Vancity, we actually is one of the few institutions that will support the previous grow-up property as long as we confirm it's been remediated.
Okay.
We will be able to take on the property as a collateral. We also don't charge any premium on the rates. So a lot of other institutions who would take that as collateral, they would charge a higher rate or fee.
It's been hard for people.
Yeah, but for us, we as long as we confirm it's been remediated, then we will be able to take that loan as a collateral.
Even if it's remediated like yesterday.
Yeah,
so
as
long you have
all
that
the
documentation,
right? That's right, yeah.
Okay.
Yeah, then we will
That's
be able
great.
to do.
All right. It's been so good having you here, Haynes. So how do people get to reach you?
I am pretty old school, so the best way to get to me is to call me.
Okay.
So if you any question, call me, text me. I always reply on the same day. I have a team of people working together with me too. So we are.
Sounds good.
Yeah, we're pretty efficient here.
Okay, we'll leave Haynes' information in the show notes or in the comments. Thank you so much for coming, Haynes.
Yes, you're welcome. Sure.
And I would really love to have you back again. Hopefully when the market goes the right way again, right?
Yeah.
So we could explain to people what they're getting and how to get it, right?
Yeah, for sure. Yeah.
Thanks a lot for coming.
Thank you. Thank you for having me here. Good? Yeah. That's okay.
Almost. That was good. That was a great flow.
Yeah.